How do seasonal factors technically play into what's likely for the stock market? Could a summer rally mean risks in the fall? We think of that. I mean, how many times has October been a bad month? Let's get a technical view and some key levels to watch for the markets. Join us now, Stephen Suttmeier, president and founder of Suttmeier Technical Strategies. July is usually good. August, maybe not so much, but a lot of times it's thin trading. A lot of people on vacation, but we all remember sell-offs leading into the fall. Past performance doesn't guarantee anything, but what can we learn from history?
Sure. History tells us that we typically get a summer rally in the market. So when you look at May through July, and you think about where we are in the presidential cycle, the first year of the cycle, that period of time, May through July, is up about 80%, on average about 5.5%. This year, it was up 13.8%. I mean, that's pretty significant. So in the first year of the presidential cycle, seasonality turns fairly negative from July through, from August through October. And, it dovetails also with the normal seasonal pattern as well. So it would not surprise us one bit to see some backing and filling in the market due to weaker seasonality. I think this year it may be more of an August event. We've run a lot of different numbers out there, and the market could hang around a bit in August. It'll hang around a bit in September. But looking at the data I've studied, it seems like we could have that traditional, scary October drawdown this year.
Scary.
With support at 6,100 to 6,200, and then resistance up at 6,600. So, are we in a trading range at this point?
No, I think we're still in this cyclical uptrend that began from April, and I think we can rally into the 6,465 to 6,600 area into year end. If we dip a little bit here, it could be 6,100 to 6,000, but maybe you test rising 26 and 40-week moving averages, roughly around 3,900. That would be perfectly normal within this sort of environment. So essentially what we're looking for really is
what did you say about 3,900?
It's where you have 26-week moving average, so a half-year moving average, and the 40-week moving average, which is like the 200-day moving average. After you get a breakout like this in an uptrend, you
3,900 on what? The S&P?
I'm sorry, I meant to say 5,900. Excuse me. 5,900 on the S&P.
I listen to what you're saying.
Thank you. I appreciate that because you corrected me there.
You're looking for 3,900.
No, 3,900 means run for the hills. So it's 5,900. My apologies.
Okay.
But no, it's so let's just summarize here. It's like basically 6,100 to 5,900 is where the big level is. And I think it's just seasonal weakness, and we can get that bounce into year end.
What do you look at the 10-year? Do you look at the yield curve? Do you have any feelings about what's happening there and whether it matters?
Well, I mean, the 10-year is just a range-bound mess of a chart. I would argue that the more discernible pattern would be in the 30-year.
Okay.
The rebound that the yield in the 30-year had towards 5% could very well be forming a rising wedge, which is typically a pattern that would suggest a downside break, meaning that the 30-year yield could go lower, perhaps into the 4.4%, maybe even down towards 4%. The other part of the curve that looks interesting is the 5-year yield, which could be forming a distribution top, meaning that if you break lower from that pattern, you could get lower 5-year yield. So, my thought is perhaps you could see continued steepening in the curve here. And
so you think we could get some cuts, like 2 or 3 cuts in this year?
I mean, not that that's my expertise, but it seems to be that when you look at the charts, it's setting up that way.
If 5 and 30 are falling and it's steepening, then the short rates would have to be going
correct.
lower.
Exactly right, and that's what the charts are suggesting.
Okay.
That there should be some cuts.
You like the big, mags, the 7 stocks. You like the S&P. You like the Russell. Is there value? Is it growth? What would you be focused on? What does technicals say?
So right here, right now, we're in a long-term secular bull market that tends to reward the biggest companies out there. So the largest stocks are going to outperform the average stock. That's been the case.
Right.
Growth is really strong versus value across market caps in the U.S. You had new relative highs for the Russell 1000 growth versus the Russell 1000 value. You had the S&P growth going to a new high versus S&P value. You have small cap growth strong versus small cap value. The interesting factor here is in one part of the world, you actually have value breaking out versus growth, and that's internationally. EAFE growth, EAFE value is breaking out from a bottom versus EAFE growth. A little bit different there. But here, large cap driven market, growth driven market, I think that should continue, and that's where we stand. I think that's very important to highlight here. So.